Ladies and gentlemen, we are seeing some huge shifts in the markets right now. And in today's video, I'm going to be going over the yield curve that's hit its steepest inversion in 40 years. And I'm going to also go over what oil prices crashing is signaling for the economy coming. And people, we've also got some more warnings from some CEOs, some billionaires, that this downturn is going to be worse than the dot-com bust, and it's also going to be worse than 2008. Because the macroeconomic picture is changing so quickly, and even though I'm sick today, this news is so urgent, so I've got to get this video out to you now. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, look at this everyone. Treasury yields inversion has even more to come than feared. So look at this chart here everyone. We can see here the yield curve has been inverting, but it's just been getting steeper and steeper. And now it is minus 0.74%. This is the steepest inversion in over 40 years. We can see here the 10-year US Treasury yield is 3.6%, while the 2-year Treasury yield is 4.4%. So what the bond market is telling us in the short term, that interest rates are going to go up much, much higher than people are thinking in the long term. And if a slight yield curve inversion is what is predicted every single recession, well, what do you think is going to happen if we're seeing the biggest yield curve inversion in over 40 years? What that tells me is that the bond market is pricing in that this downturn is going to be much worse than anything we've faced in recent decades. But the yield curve inverting alone isn't enough to predict that we are going to be facing a painful recession. Something that's happened recently is oil has been crashing. Now, I've been saying that I think oil will go up next year when they start to refill their strategic petroleum reserves, the US that is. But what's happening in the short term is when we're seeing these protests erupt in China. Remember, China is the second biggest economy in the world, and they're a huge user of oil. While this is the oil market thinking that there's going to be demand destruction. Remember what happened in 2020 when the global economy went into lockdown? Oil prices went actually negative because demand was going to fall so much. So what this is telling us now, what's happening with oil, is demand is going to absolutely plummet when we do officially enter a recession. And again, people, this recession is going to be much, much worse than recent recessions we've had because central banks aren't going to be there to bail us out this time. So look at this price run. This is crude oil. We can see here it hit a recent peak in March around $119 per barrel. But it's been crashing. It's now fallen all the way down to $76 per barrel. This defying forecast, crude oil prices have wiped out most of this year's gains and could head lower. And this is why. Macro headwinds rather than tailwinds, China's lockdowns and the rare protests against Beijing this weekend have raised more doubt about the outlook for the country's already weakened economy. We think the recession forces around the world, particularly in the three largest economies, are dominating the macro environment for the year as a whole, and we think that the issue we've been identifying as a relatively bumpy in the period ahead are going to remain. Right now, we are looking at the macro headwinds rather than the tailwinds. So that's right, everyone. Another reason why this recession is going to be so much worse is this is going to be a global recession, which again, I think is going to lead to a depression in late 2023 or early 2024. Because it's not just the US going to be going into recession. China, the second biggest economy, is going to be going in recession, and Europe is going to be in a big, painful recession as well. We see how bad the energy crisis is. We see how bad inflation is in Europe, but central banks, they aren't going to be able to stop inflation at all. They're not going to be able to even come close. We've got the UK inflation rate at around 11%, nearly 12%, and they've only got interest rates at 3%. And because the global economy is so interconnected, like what we found in 2008, and now it's even more interconnected, there's even more globalization, while this is going to cause domino effects for the whole world. Right now, they're predicting a target below $60 for WTI. That's what the chart is indicating. This is a new low for the move. Previously, the low for the year was late September, and now we've broken that. It all depends on what happens in China. China is important on the demand side as OPEC is on the supply side. So that's right, everyone, why OPEC is cutting production while demand is going to fall even more than that. So these are the two biggest macroeconomic indicators that we are going to be facing tough times ahead. But it's not just the indicators saying this. We're also seeing billionaire CEOs and venture capitalists warning that this is going to get very, very bad. Get ready for a prolonged downturn that's worse than 2000 or 2008. Billionaire VC Doug Leone says. He's warning tech leaders and investors have been forced to reckon with high interest rates and deteriorating macroeconomic conditions, and he says he doesn't expect the economy to recover till at least 2024. So he's definitely right there, everyone. We're seeing tech stocks get absolutely smashed. We're seeing interest rates skyrocket, and this affects tech stocks the most because a lot of them rely on capital, a lot of them rely on debt to grow, and there's just been cheap money, easy money for the past 14 years interest rates have only been going lower, and these tech companies have been getting complacent. We're seeing what's happened with Facebook Meta. Meta's lost nearly $1 trillion in market cap. We're seeing what happened with Mark Zuckerberg's net worth. He's lost $100 billion. We see what's happening with Elon Musk. He's lost $100 billion in net worth. He's severely overpaid for Twitter. Twitter is losing millions of dollars every day. I think he can turn it around, but it is going to be a very tough time for the tech industry. He said why it's different to 2000, 2008. Here we have a global crisis. We have interest rates around the world increasing. Consumers globally are starting to run out of money, and we have an energy crisis. And then we have all the issues of geopolitical challenges. So that's right, everyone. US personal savings rate is crashing to new lows. And going in the opposite direction is consumer loans, credit cards, and other revolving plans, all commercial banks. Well, this is going in the other direction, and consumer credit cards has hit an all-time high, and it's approaching $1 trillion in debt. So savings going down and credit card debt skyrocketing. Well, it doesn't take an economist to figure out this is a recipe for disaster. And it's been consumers being able to take on more and more debt is a reason why it hasn't gotten so bad yet. But eventually people, they max out those credit cards, and that's when things are really going to hit the fan. And he's saying these tech companies are going to have to learn a very hard lesson. You were rewarded no matter what. You made a bad decision, you got money. You made a good decision, you got money. This is a lousy way for you to learn your craft. All that is gone. So again, that's right. We had so many terrible companies just had money thrown at it. You just created an EV company in 2020 and 2021. You had billions thrown at it. You just created a cryptocurrency in 2020 and 2021 while they created billions and billions of dollars in value. People, this was just like what happened in 2000 with pets.com, and it was doomed to fail. My forecast is that we're not going to get away with this very quickly. If you turn back to the 70s, which they keep comparing today to, and the yield curve is as bad as the 70s, there was a malaise of 16 years. Even if you go back to 2000, a number of public companies didn't recover for 10 years. So that's exactly right, everyone. You see so many young financial YouTubers that have never experienced a recession or a prolonged downturn. They keep saying, buy the dip, it'll recover next year, or even worst case scenario, 5 years. Well, no, there's been many times where the S&P 500 didn't recover for over 20 years. For example, after 1968, didn't recover till the early 1990s, and after the Great Depression, 1929, it didn't recover until the mid-1950s. And while you may be okay if you're in your early 20s or early 30s, my audience is very different. I have a lot of you watching that are in their mid-40s or mid-50s. So you don't have 20 years to recover your funds because most of you will be facing retirement soon. Because let's quickly talk about what happened in the markets today. So we saw the S&P 500 dropped around 1.5%, and a big reason for that, people, was because Apple fell 2.6%. Apple is the biggest stock in the S&P 500, so when Apple goes down, the whole market goes down. And again, the big reason for that is because of the huge protests we're seeing in China, which is going to severely delay the production of the iPhone. So everyone, I know you're thinking, well, okay, what does all this economic jargon mean for you in simple terms? Well, what this means, everyone, every single macroeconomic indicator, the yield curve, oil prices crashing, the tech industry crashing. We're seeing more and more companies declare bankruptcy. We're seeing the markets, they are still in a bear market, even though they've had little rallies here, people. Again, these are just bear market rallies, and we are going to go lower. We haven't even felt or got the data of how bad these interest rate hikes are affecting the economy. And the Federal Reserve has not stopped hiking. They're going to go to at least 5%, so we haven't seen the worst of it yet. So everyone, you're definitely going to want to prepare right now. If you got any debt, pay it off, because debt is going to get much, much more expensive. If you haven't got an emergency fund, get an emergency fund now. So do those two things before you even start thinking about investing in the markets. And then if you've prepared all your essential items, you got your preps, your extra food, storage, etc. Well, then a way I'm hedging against this possible downturn is by investing in gold and silver. Again, not financial advice for what you should do, but this is what I'm doing, because every single person's situation is different. Because history tells us when things really hit the fan, when we experience high inflation or stagflation, that's when gold and silver really soars. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers who are watching, you're awesome. Thanks for watching. I'll see you all in the next video.